All right, welcome back inside our proactive newsroom. And joining me now is Sean Dranfield. He is the CEO of PT Asset Management. And Sean, it's good to see you. How are you?
I'm well, Steve. How are you?
I'm doing well, thank you. And I want to talk about the recent launch of the Performance Trust Total Return Bond ETF. And we'll talk about it in just a second, but let's take a little bit of a step back and talk a bit more about you and your company and how you look at things a little bit differently than I think other people in your sector.
Sure, sure. So we're a Chicago-based domestic bond boutique. When I say domestic, I mean U.S. bond boutique. We've been around for, over 15 years. Uh, we have four bond funds in the US that have done very well pretty consistently. But I think the thing that really sets us apart is the way we think about bonds. So we have this methodology that's proprietary to us. It's called Shape Management. It was actually developed by our sister company over 30 years ago. And it's a way to really address what we see as some fundamental shortcomings in the way traditionally people have been taught to think and look at bonds.
Yeah, let's talk about those because you had said and reading up on your company just about the metrics that a lot of people use really are very troublesome in predicting what's going to happen. It's very difficult for people to actually, be true sayers, so to speak.
Yeah, absolutely. So thanks for that, Steve. So, I think there are three traditional metrics that many people use to think about allocating to bonds or constructing a bond portfolio that we think can oftentimes lead people astray. So the first fairly obvious one is this idea that anyone can predict interest rates and where they're going. I think despite the fact that people sort of acknowledge that may be true, that's often what people still do. And what I would point to is, even if we may know what the Central Bank of England, the ECB, the Fed, the Bank of Canada is going to do as it relates to interest rates, it really means nothing about the entire yield curve. So, to give you an example, last year, even if you had a crystal ball and you knew that the Fed was going to raise rates six times at the short end of the curve, that wouldn't have told you anything about the rest of the yield curve. And so, for example, the 10-year Treasury started last year yielding 388. It ended last year yielding exactly 388. So interest rates at the 10-year part of the yield curve were entirely unchanged. So we would argue that even if you did have a crystal ball and you knew what was happening with the central bank, it tells you nothing about all other interest rates. So we developed this methodology to really overcome that flaw. And then at a more granular level, I think buyers and sellers of bonds often defer to two shorthand metrics when thinking about bonds, namely yield as a proxy for total return and duration as a proxy for interest rate risk. These metrics are widely known, they're used by everybody, but they're flawed. So yield is really never what you get on an actual bond in terms of total return. The only time it would be is if you bought a zero coupon bond and you held that bond to maturity. Duration is an even more flawed metric. Duration is meant to predict, the price movement of a bond for, say, 100 basis point movement in interest rates, but it does a very, very bad job of predicting what will actually happen to price because there are other things that drive price that are mathematical that are not measured by duration. I'll give you one example. So typically, yield curves are upward sloping. They're not today, although they're getting there. Why are they upward sloping? Well, if you lent money to the government for, say, 30 years, you would expect a higher yield on your investment than if you lent money to the government for a day. So typically, there's a term structure of interest rates with an upward slope. If you bought a 10-year treasury right now, let's say it's yielding 4%. If you had an upward sloping yield curve, let's say theoretically a 7-year treasury was yielding 3.5%. In 3 years' time, that 10-year treasury would become a 7-year treasury and it would roll down the yield curve. And as you know, when yields go down on a bond, prices go up. So that's one of many examples of something that could drive future price that neither duration nor yield measures. And the beauty of bonds, unlike equities, is they are mathematical instruments. So they have this knowability to them that you never have with an equity. So an example of that would be, and this is like, I'm just going to I can pick on any stock, Google, Tesla, you name the stock. I may not know, I don't know what the total return of Google is going to be in 12 months. I may be able to read research that predicts its dividend and its price, but I don't know. Unlike unlike stocks, bonds have total returns that are comprised of income and price as well, but they're knowable. So the income stream on a bond is a contractual obligation. It's not like a dividend, so it's knowable. I may not know what the price of a bond will be, but if you tell me what interest rates are going to be, I can tell you to the 10th decimal place how a bond will price in the future if I understand its structure. So it's basically a very different sort of operating system from stocks. And our view is if you do that very granular math, you're going to have much more information about future bond prices. And so that's what we do. We basically say, these three metrics are flawed. There's a better way of looking at bonds. It's called shape management. It's a way of overcoming these fundamental flaws and recognizing that bonds are math. And it also addresses the idea that interest rates are unpredictable. So we have very much sort of a rate agnostic approach to looking at bonds where I don't know if rates are going up or down. So I try to basically combine bonds with different types of total return profiles that might help you if rates go up, combined with bonds that might help you if rates go down. And what that's led to for us is a much more steady, consistent, and frankly, quite strong total return profile relative to both indices and our competition. So I
Yeah.
hope I didn't bore you too much with sort of
No.
the nerdiness of bond math, but that's sort of what sets us apart from everyone else.
Absolutely. And so are you, lastly, Sean, are you seeing people that would want to get more information about the Performance Trust Total Return Bond and really about that they feel that it's a bit safer in the market type thing? Is that the kind of the feedback that you hear from people
Yeah,
when they
I,
want?
I would I would say what we hear. So this ETF we're partnered with Han ETF in London, which we're very
Yeah.
excited about. They're also, a boutique an independent boutique just like us, and their clients are predominantly European investors. And so what's interesting about the European bond market versus the US bond market is there's one stark similarity and then there's also one stark difference. The stark
Yeah.
similarity is if you look at the European ag and the US ag, they're all full of rate sensitive bonds. So the ag is all full of US treasuries, IG corporates, and residential mortgages. Those bonds are rate sensitive instruments. The European ag is similar in that it's all rate sensitive instruments, primarily govies and IG corporates. But the difference is there's very little structured credit in the European bond market. And what's interesting about the structured credit market in the US is that's often the place we hunt for defense. And when I say defense, I mean bonds that are going to help you if rates go up. So when I talk to our prospective clients in Europe, they're mainly holding European bonds, either by buying bonds themselves or through structures, ETFs or mutual funds. And so our argument would be, hey, this approach, the shape management thing, we think is pretty compelling, but also we're going to be able to construct a portfolio for you that when you combine it with your bonds is going to deliver a smoother total return profile over time because we're going to be able to help you by offering you bonds with shapes that are less sensitive to interest rate movements in sectors that you really don't have access into in Europe because the structured credit market is very, very small in Europe relative to the US. So
Yeah.
I think that's really how we can really help our prospective clients in Europe.
Sean, thanks so much. Great to chat with you today about the ETF and the excitement around it. And we really appreciate a conversation today and your insight into what's going on around the world in the bond market.
Thanks very much, Steve. Really appreciate your time and have a good rest of your day.
You as well. There's Sean Dranfield. He is the CEO of PT Asset Management.